We took a $2 billion loss, and we made it clear it could get worse before it gets better. You know, it could be volatile by $1 billion possibly. We made a terrible, egregious mistake. There's almost no excuse for it.
That's JP Morgan CEO Jamie Dimon talking about big trading losses that JP Morgan has, of course, sustained. And, well, it turns out they knew about the risky trading practices of this trading group as long as 2 years ago. My Heard on the Street colleague David Riley joins me now to talk about this.
Good morning,
let's catch up. Good morning, Dave. First of all, before we get into the meeting, tell us catch us up on what's going on here, really.
So what we had was back in earlier this year, our colleagues, Greg Zuckerman and some others, reported that there had been this trader in London, and JP Morgan and what's called the Chief Investment Office had undertaken these massive trades and become known as the London Whale. JP Morgan comes out and says, this is a tempest in a teapot, it's nothing. During its earnings call a couple weeks later, they come out and say, actually, it's a huge deal.
$2 billion
we're losing
of losses.
Maybe $5 billion.
Maybe $5 billion. It could be that they've still got some of these risky positions on.
Multiple investigations going on. This has hammered the bank's stock. They've lost about $25 billion in value since then. And tomorrow morning, Jamie Dimon goes to Capitol Hill, where he's going to be grilled by the Senate Banking Committee.
Let's jump into that in a second. But, of course, the Page One story today, which we have in the Journal, it notes that actually these guys saw this London office had been engaged in some risky trading practices as early as 2010. Actually, it goes back to 2008. Said they had some winners, right? They had some winners betting the market was going to go down. Then fast forward to 2010, they basically took some foreign exchange options trades.
Foreign exchange options trades
lost
that went
$300
bad
million or so.
About that. Then, and really what you're looking at here is since at least the past 2 years, were there red flags being raised within JP Morgan? And was JP Morgan either missing them or ignoring them? And I think that's what becomes so important about this, because right now it's sort of being painted as, suddenly we had these trades that were put on sometime late last year, they went bad, we suffered a huge loss.
What's the answer? Do we know?
I don't think we know yet, and I think that's what, from the hearings, because keep in mind, JP Morgan, when it came out with this, it came out with it had a conference call, but basically said, we're still investigating. And what they told investors and the public was, we will tell you a lot more come the second quarter results, which will be released in July. So with Jamie Dimon going to the Senate Banking Committee tomorrow, and then the following week to the House Financial Services Committee, we get a sense that they probably have their hands much more around this now. So we should start getting a fuller picture of what exactly
he's not going to show up really without offering us some details.
I don't think he's going to show up and just say, sorry, senators, you
what
wait
should
till
they
the
be
call
asking
in a month.
him? I mean, what are the key issues here, and how, give us some questions. The Senate Banking, the House Financial Services, they don't always acquit themselves particularly well when it comes to...
One of the big things, first of all, is just, how warnings like this, how far up the chain of command did they go? Why were they ignored? Or were they ignored in the first place? As part of this, earlier this year, a key risk model within the bank's Chief Investment Office was changed. Who knew about that? Who approved it? Did the regulators know about it? Did the auditors know about it? How did these things take place? What were the controls in place? And the important thing to remember is that this unit, who's headed by a woman named Ina Drew, who's since retired from the bank, reported directly into Jamie Dimon. So ultimately, the buck stops with him.
And our story mentions that he actually knew about the $300 million trading loss in the Forex options. Now, that actually doesn't sound like a huge number, but it sounds like he was aware that this particular group was
taking some, positions that could move the needle. And that goes to the bigger question, too, because what JP Morgan has said is, these were hedges meant to offset the risk of the bank, although Jamie Dimon has then subsequently said, well, they morphed into something else without actually saying what they morphed into.
How does he perform this dance, if you will, where he's trying to say, yeah, this was a big deal, we messed up, egregious errors, what have you, but no, we don't need a Volcker rule. We don't need any restrictions on banks preventing trading.
I don't think he's ever said, we shouldn't have any sort of Volcker rule. I do agree that I think, the whole Jamie Dimon has been against all regulation. No, that's not true. He's been taking a nuanced, he's been fighting positions on it.
Okay.
So, and I think, though, what he has said, we should be able to hedge the overall credit risk of the bank. And now what this is calling into question is, are you really hedging here, or is this just a way for you to mask what are just outsized bets and what's essentially a big hedge fund within the bank? And that's what's going to be a big question for the Congressional Committee.
And what do you think? What do you think comes out of it? Is it's going to be a lot of hand wringing? It's going to be a lot of, well, probably grandstanding. But I mean, is there any policy impact that we can expect from all of this?
There's possibly some big policy impacts. I mean, what's interesting is, in some ways, almost as interesting, although it wasn't as noticed, was a week ago we had a hearing before the Senate Banking Committee with a number of the key regulators, the head of the OCC, the FDIC, Daniel Tarullo, the Fed governor, who's the point man on regulation, Richard Cordray, the head of the Consumer Financial Protection Bureau, and to a man, every one of them said, well, we're thinking about things differently because of what happened at JP Morgan. This is very much influencing the policy debate around things like the Volcker Rule and about how key elements of the Dodd-Frank financial overhaul legislation are put into place.